Okay, so welcome to today, which is fact 4864. We're going to do foreign subsidiaries. So I'm going to give you a quick overview. It's literally going to take like 10-15 minutes because really to see it, we're going to have to do it. Okay, so doing foreign subs is going to, that's basically how you're going to learn. So what's going to happen over here? You're going to be given a scenario where you have a subsidiary that is not, that's functional currency is not denominated in the functional currency of the group. So so for our case, the functional currency of the group is going to be, the functional and presentation currency of the group is going to be ZAR, South African Rand. So presentation currency is the currency in which the financial statements are presented. It may not necessarily be the functional currency. The functional currency is basically the currency in which the company or the entity operates in, okay, operates with. So for South African company, the functional currency is going to be ZAR, because that's what we operate with. And for South African company, your presentation currency will also be in ZAR. Okay, so that's why there's no foreign currency issues. But now there's going to be a situation where one of your subsidiaries, well, it can be more than one, but I think they're limited to one, where one of your subsidiaries, or not, let me just rephrase that, not one of your subsidiaries, one of your group entities will be denominated in a foreign currency. So let's say you have a company in Nigeria, or you have a company in Australia. So for example, Woolworths have a company in Australia, and perhaps the functional currency is ZAR. I mean, the presentation currency is ZAR. ShopRite have plenty of companies in foreign, in the rest of Africa. Sanlam, for example, they have, I think like they're in 33 different African countries. So all of those countries, you have different currencies that they operate in. So the functional currency of those entities will be whatever it is. But when Sanlam prepares the group financial statements, that's presented in ZAR. So all those companies that are from other African countries that is not using South African Rand will need to be converted into ZAR, so the South African into ZAR, which is the presentation currency. So what's going to happen? So you're going to have a company that is going to be in a foreign currency, and you're going to have to consolidate or equity account that company as part of the group financial statements. But that company is going to be in a foreign currency. But when we do consolidation or equity accounting, we need to make it ZAR. So what are we going to do? We're going to have to apply foreign IAS 21, foreign exchange, what's called foreign exchange, what's it called? Something like that, okay? Translation of foreign currencies, okay? So we're going to have to apply those principles. Now, the big thing, when it was a non-group situation, so you were a company and you just ordered a machine from America and you paid in USD. So when you brought it over, you converted it to ZAR at the spot rate. And let's say you paid the supplier 2 months later, then you had a foreign currency translation when you had to make a payment, and the foreign currency gain or loss goes through profit or loss. That was when you were non-group. Now we're dealing with a group situation. We have to translate not a transaction, we have to translate an entire company, the trial balances of an entire company. So the question, how do we do that? So the way you're going to do that is we're going to have the foreign currency amounts, and then we're going to have to translate it using an appropriate exchange rate. So the rules or the principle is that any balance sheet is translated at the closing rate, okay? And then any transaction should be translated at the transaction date. But obviously, as we know, we're not going to be dealing with transaction dates. So if you don't have a transaction date, then you can use an average exchange rate. So for us, when it's a transaction, we're going to use, so when it's income statement line items, we're going to use an average rate. So remember, the technical rule is that you can only use an average exchange rate if it closely approximates the transaction date. So in the real world, because we use accounting systems, and most accounting systems deal with multi-currencies, if you select an accounting system that can handle multi-currencies, then the accounting system will recognize an amount using the spot rate on the date of transaction. But that's in the real world. We're not now in the real world. We in an academic world. We can't translate every transaction at spot rate, because then you're going to need the whole day to write. So when it's an income statement, we use average. At the moment we're dealing with a closing balance or with a balance sheet line item, we're going to use the closing spot rate. Now, what you will notice is that some balances will be translated using a spot rate, and some balances will be translated using an average rate. That's going to cause a mismatch, okay? Or that's going to cause an unbalancing figure. And that unbalancing figure is basically your foreign exchange. Now, with a normal foreign exchange, what happens? We recognize a normal foreign exchange through profit or loss. Profit or loss is closed off to retained earnings. In this scenario, in a group situation, we don't close off a translation as a result of presentation, or as a result of going from functional to presentation. We don't take that to profit or loss. We take it to other comprehensive income, and when we take something to profit or loss, it gets closed off to retained earnings. Typically, when you take something to OCI, it has its own T account. So for example, it has its own balance, So for example, when we had a revaluation gain on PPE land, we had a column or a balance called revaluation surplus. When we had a fair value gain or loss on going through OCI as a result of financial instruments, we had a column or a balance called mark-to-market reserve. Now, similarly over here, when we're dealing with this foreign currency translation for a group situation relating to going from functional to presentation currency, we're going to have a separate balance called FCTR, Foreign Currency Translation Reserve. So like what you should know, there's no requirement to have a separate balance, but we do just have a separate balance. So just take note of that. So something that goes through profit or loss is closed off to retained earnings. When something goes through OCI, in many cases, they will have a separate equity balance for each type of transaction going through OCI. So like I said, when it was fair value through OCI relating to financial instruments, then we took it to mark-to-market reserve. When we had a revaluation gain relating to PPE that goes through OCI, we call the revaluation surplus. So similarly over here, when we have a foreign currency translation reserve transaction, we're going to have a balance, an equity balance called FCTR, Foreign Currency Translation Reserve. So that is basically the key thing over here. What's the key thing? That we're going to have to convert a subsidiary or an associate from its functional currency to the South African presentation currency, to the group presentation currency. The group presentation currency will most likely be ZAR. And then you're going to see the process we follow is going to result in there being a balancing figure. And that balancing figure is your foreign currency translation reserve. Now, Now, this is the key thing over here. This is the key thing over here. When we had, I don't know if you remember this, but basically, when you have an OCI balance, okay, when you have an OCI balance, so for example, revaluation surplus, mark-to-market reserve, and so forth, you will be able, the accounting standard allows you to transfer from, when you make a sale, when you realize that OCI, you can transfer from the revaluation to retained earnings. Okay, so you can do that. And that is what's going to happen in this scenario. You have to do a transfer. So that is basically going to be the most challenging aspect. But we will get to that tomorrow. This will only happen when there's a change in ownership. And so whenever there's a change in ownership, you're going to have this, we're going to have to recalculate the foreign currency translation reserve. So we will deal with that tomorrow. That is the most challenging aspect. The rest is fairly simple. And that is why I said to get this change in ownership adjustment to foreign currency translation reserve, please make sure you know normal change in ownership, because if you must still be able to deal with normal change in ownership, and this doesn't become a bit confusing, but if you're okay with normal change in ownership, then it's going to be fairly straightforward to understand the adjustment we're going to make to this foreign currency translation reserve. So we're not going to deal with that today. We'll deal with that tomorrow. What we're going to do, I'm going to read the entire scenario relating to this question, and we're going to do one aspect. Okay, then tomorrow we will continue the question. We're going to have to do journal entries. But one of the main issues is how to deal with a foreign currency translation as a result of changing ownership. Then what I'm going to give you for homework for the weekend is to do another question. It's going to be completely different, but the principles will remain fairly the same. You can attempt it, and then we're going to, depending on the queries we have, the queries I get, I will decide whether I have a group discussion with you, or I'll just send individual responses to it. So that's going to be the process so that you can do foreign currencies. It's not difficult, but you are going to require to apply your mind a little bit. You're going to see that if you get foreign currency, you're going to, it's going to improve your understanding of groups also a bit. Okay, so so try to look at it more in a positive manner. So now I'm going to switch over. I don't know if I sent you the question. We just see, I'm going to send it here in this. Do you have access to Google Drive? I'm going to, let me just send it here quickly. I'm not sure if I sent it to you guys now. Can I send it in the chat? What was I doing now? Okay, so I'm going to switch over to that scenario. Where is it now? Okay, you should be able to see the scenario in front of you. I'm just going to read it with you now. And then we're going to go. So if you got it in the chat, it is on page 50. It is question 2. So I'm going to give you about 2 minutes to open it if you do have it there. And then we're going to start it in next 2 minutes. Okay. I am going to start reading now. So part 1, you're going to do part 1, which is 25-mark question. The other 15 marks is cash flows. Okay. I just want to, when we go through this, I'm going to show you cash flows, how they'll test it in a fact 4 situation. So remember, for CT level 1, the full 40 marks is cash flow. So they ask cash flows from start to finish. Whereas for CTA level 2, you're not going to get a full cash flow question. I won't say you're not going to get it, highly unlikely, because they want to test foreign subsidiaries. So generally, more than 50% of your paper is going to be foreign subsidiaries. The other 50% will be split between cash flows and integrated reporting. Typically, of the remaining, integrated reporting will count 5 marks, and then that means 10 marks will be cash flows. Okay, so generally, how they're going to ask cash flows, they'll either ask you for a specific line item or just for one of the activities. So for example, financing activities or investing activities. Or they will, like, for example, like I told you, cash paid to suppliers and employees is generally like 10 marks alone. So they may just ask you for that line item. Or they may ask you for cash generated from operations, because remember, cash generated from operations is cash received from customers minus cash paid to suppliers and employees. Now, cash paid to suppliers and employees will count about 10 marks, and then like 3 marks is cash received from customers. So just be aware of that. They're not going to ask you for full cash flow. So you must be able to work out any aspect of a cash flow. Okay, so just be aware of that. But typically, 25 marks is going to be foreign subsidiaries. So what they're going to test over here, they're testing normal groups, because you must know normal groups. They're going to test change in ownership, but all of that is going to come with foreign subsidiaries. What I can tell you, the chance of them giving you a complex group, unlikely in test 4. But obviously in an exam, they can give you a 100-mark group question that covers every aspect of groups. That is a complex group that have like, what, 10 different companies. Okay, so just be aware. It is normal. It's not something absurd. So over here, they're going to keep it simplified. They're probably not going to deal with too much intercompany transactions, if any. They're not going to deal with any adjustments at acquisition. They may, but highly unlikely. In the exam scenario, then you must expect anything. Okay, so over here, not so much. So let's deal with this. So we say, are we there yet? Is a South African company that operates in the education and training sector and is listed on the Johannesburg Stock Exchange. Are you there yet? Is a parent company that has investments in the education and training sector. The functional currency is the South African rand. All companies in the group have a 31 March year end. The following balances have been included by the group accountant of, are you there yet? In the preliminary consolidated trial balance for the year ended 31 March 2019. So you know the information given is for the current year ended 31 March 2019. That means the beginning of the financial year must have been 1 April 2018. So just write down that for yourself. 1 April 2018, draw a line, 31 March 2019. Don't try to remember that. There's no need to have that load on your brain. So just write it down so it's easy to see, okay? So here they're giving us debit or credit in Rand, in ZAR. So now in dealing with foreign currency, it's very important to identify what currency the amount is in. So the trial balance is in ZAR. So they say the following, okay, we read that. So investment in Endgame PLC. So when you see PLC, you already know it's probably going to be foreign. So we will see what company it is, for which country. So because we don't have PLC. In South Africa, we have LTD, we have PTY LTD, and we can have other stuff, but we don't have PLC. Okay, so PLC union like in the UK, or maybe any, I don't know, other countries as well. So let's say investment in Endgame PLC, we have 42,500 ordinary shares at cost, which is 176 million Rand. Okay, then we have a loan to Endgame. Okay, so this is now an important aspect when it comes to the loan. You must be on the lookout for a loan. So the loan can be treated in one of two ways. The loan can be a normal loan, but the loan can also be part of the investment. So for example, the investment could be the loan plus the investment, or could just be the investment on its own. So what will trigger whether you must include the loan as part of the investment is the terms of the loan. If the terms of the loan stipulates or don't stipulate so if the term of the loan stipulates that there's no specified date of repayment, or the loan does not specify a date of repayment, that means the loan is there forever and ever, then it's more likely going to be included as part of the investment. Okay, so that is how the accounting standard treats it, because they know some companies provide a loan to, some group companies provide a loan, so the parent will generally provide a loan to a subsidiary. They're not having an additional investment, they're providing a loan, financial assistance, yet there is no real terms of repayment. So the accounting treats that as an additional investment. Okay, but we'll see how we exactly treat with it. It's more have a specific impact on foreign currency, how you deal with foreign currency. Okay, so the loan, it is 56,000 Rand or million Rand. Dividends paid on 28 February 2019, 34 million. Then we have share capital, which is 50,000 issued ordinary shares. We have a retained earnings on 1 April 2018. So take note that retained earnings at the beginning of the year. Then we have profit after tax for the year, attributable to the owner. And then we have non-controlling interest. Okay, very important. They could have just said that is profit for the year, but they're telling you that is profit attributable to the owner. And then you have non-controlling interest, which is the statement of financial position. So they say the group accountant has indicated that he is clueless regarding IAS 21, the effects of changes in foreign exchange rates, and was therefore unable to consolidate the financial results of the foreign operation Endgame. So now you know Endgame is a foreign operation. He consolidated everything besides Endgame because he does not know how to do it. Okay, the non-controlling interest of 45 million included in the preliminary consolidated trial balance relate to other subsidiaries that have already been correctly consolidated by the group accountant. The information relating to the foreign operation is provided in the paragraphs below. So, as you can see, the non-controlling interest is only for other subsidiaries. So, by the sounds of it, the accountant did the other consolidations correct. The only thing he could not do is include the foreign operation. So what are we going to have to do? We're going to have to do the foreign operation. Okay. So let's say on 1 April 2018, AWT acquired 42,500 of the ordinary shares of Endgame. And from that date, AWT had control of Endgame as per the definition of control. Endgame is a Zambian registered company and has a Zambian, whatever that is, at its functional currency. All assets and liabilities of Endgame were deemed to be fairly valued at the acquisition date. No additional assets, liabilities, or contingent liabilities were identified at the acquisition date. AWT elected to measure the non-controlling interest at its proportionate share of the acquiree's identifiable net assets at acquisition date. So as you can see over there, there's no fair value adjustments and so forth, so that's fine. So here they say the group accountant correctly calculated goodwill at the acquisition date as follows. So giving you a draft analysis of equity. What am I reading now? The group accountant correctly calculated goodwill. Okay, draft analysis of equity of Endgame. Okay, so here we have. So what we're going to do when it comes to foreign subs. So basically the best way to do the calculation for a foreign currency translation is to set up an analysis of equity. So I don't use analysis of equity for any other thing, but we will do it over here because it's kind of the easiest way to calculate the foreign currency. So I'll explain to you how we'll deal with it. But this setup over here is exactly how we're going to set up an analysis of equity when you have a foreign operation. So there they have at acquisition. We have share capital, we have retained earnings, we have total equity. Then there's a equity represented by goodwill, and that will give you total equity. Okay, so we will deal with that. So there you can see all of those numbers. So as you can see, our percentage is 85% and NCI is 15%. AWT granted an interest-free loan to Endgame on 1 April 2018, repayable in South African rands. However, AWT did not stipulate any settlement terms for the loan granted to Endgame. The terms and conditions of the loan as agreed upon on 1 April 2018 are unlikely to change in the foreseeable future. Endgame recorded the loan in its statement of financial position as at 31 March 2019 at 40 million ZMQ, whatever that is. So just take note of, so it's an interest-free loan and there's no repayable amount. So that is the ZM, whatever it is, okay? So what they needed to do, actually, they have to pay us back in ZAR. So they would have to do a foreign currency transaction every single time, okay? Because remember, they have a loan in their books, they including the loan at in ZMK, because to them the loan is a because to the foreign operation, who's the foreign operation, to Endgame. So you must just take note of this now. Endgame has a loan from AWT. Okay. In-game's functional currency is Zambian, whatever it is. Okay, so let's whatever I'm just gonna call it Zambian currency. Okay, so their functional currency is Zambian currency. So in their books, they're going to record the loan in Zambian currency. But take note, to the foreign currency, to in-game, they need to pay back the loan in ZAR. So every single year, what they're going to have to do, they're going to have to do a foreign currency translation. So just picture that. You put yourself in the shoes of the Zambian, of in-game's accountant. So in-game's accountant have a loan from South Africa. The loan is repayable in ZAR. So therefore, to them, they're going to have to do a foreign currency translation at year end every time, because they have because to ZMK, to in-game, they have a foreign denominated loan. So just take note of that, okay? So in-game declared and paid a dividend of 25 million ZMK on 28 February 2019. In-game reported a profit after tax, excluding any of the foreign exchange difference on the loan. So just take a note. They have a, so in-game have a profit after tax of 36.7 million, but that does not include any foreign exchange difference of foreign translation relating to the loan. So remember, when you have a normal transaction that is denominated in a foreign currency, any gain or loss, forex gain or loss, goes through profit or loss. So they did not account for foreign forex adjustments relating to the loan. So therefore, that profit is not 100% correct, because we need to still bring into account that foreign exchange adjustment to their profit or loss amount. But I'll reiterate when I do the calculation. This is going to be an important aspect to take note. So the first aspect over here relating to the loan is that putting your shoes is to put yourself in the shoes of the accountant of in-game. So being the accountant of in-game, you have a loan that is a foreign loan. You have a loan from a South African company that is denominated in ZAR. Your functional currency is ZMK. So when you do your financial statements at year end, you're going to have to do a foreign currency translation for that loan. Any gain or loss will have to go through profit or loss. That is the aspect from putting yourself in the shoes of the in-game's accountant. Then the second hat you need to wear is to put yourself in the shoes of the accountant, of the group accountant of AWT, and that will be a different issue. So just take a note of that. Okay, number 3. What's our year end? Yeah, so number 3, I'm not going to read. This has got to do with the journal we're going to have to fix. I don't think we're going to need anything over here, so I'm not going to read that. We can ignore that for now. Yeah, so I'm not going to worry with that for now. So here we're going to have additional information. So under the additional information, all the amounts provided may be accepted as correct, except where indicated otherwise. Income and expenses were incurred and earned evenly throughout the respective reporting periods. The applicable exchange rates were as follows. So here you can see the first 3 are closing rates, and then you're going to have the last 2 are average rates. Okay, so just take note of that. So point number 3 is the journal where we have a there's a change in ownership, but the change in ownership doesn't happen in the 2019 financial year. It happens in the 2020 financial year. Okay, so yeah, you can see the change in ownership took place. Wait, was it result? Okay, somewhere it happened over here, but it's not in. Yeah, so I think it happened on the 30th of June or something like that. So I think it happened on the 30th of June. The change in ownership happened 2019, our financial year, 1 April 2018 to 31 March 2019. So that is in the new financial year, so I'm not going to deal with that. So we're only going to deal with the 2019 financial year. Number 3, the change in ownership happens in the 2020 financial year, and we're going to deal with that tomorrow. So this aspect will take a good hour or so for us to comprehend and understand, but it's not, obviously can't take you that long when you actually answer it in an exam. So we're going to go to the required. I'm going to show you the required. Part 2 is just basically cash flows. So part 1, prepare only the equity section of the consolidated statement of financial position of what? Of the Are We There Yet group as at 31 March 2019. Okay, so that is what we're going to deal with. This one over here is to complete the journal entries on 30th June 2019. 30th June 2019 is after that date. So therefore, that point number 3 is not relevant for what we need to calculate above. Okay, so here you can see half of the marks is for the journal entry, the change in ownership on the date, just for the journal entries on the change in ownership date, 12 marks, and then 12 marks for the SFP equity section. So what's important, you must be able to do the equity section in terms of the statement of financial position, but you're also going to need to be able to do the equity section, equity in terms of the statement of changes in equity. That's going to be your homework, okay, when we come there. So say round of all amounts, show all, okay, we're happy with that. I just want to show you this quickly. So here you can see, they say, prepare only the net cash flows from operating activities section of the consolidated statement of cash flows as at 31 March 2019 using the indirect method. So they're giving you a lot of information, but all of that information is not necessarily relevant to calculating net operating activities. So you must know, when you look at that, what is applicable to net operating activities. So for example, where's this? Okay, you must just have a look whether any of those would be applicable, right? So just be aware, you must be able to calculate that. You can attempt that, and if you have any questions, you can let me know. Then you have, so that's 13, 1 mark for layout, which is 14 marks. Then they say list according to the GRI level C guidelines, the elements, whatever it is, okay? 1 mark. So you can either have a sleepless night on that if you don't know what that is, or you can ignore the 1 mark. It's up to you. For me, I would ignore that 1 mark because I'm going to focus on the big marks. Okay, but remember, the year it's 1 mark. It could have been 5 marks. I have no clue what is GRI, Global Reporting Initiative Level C Guidelines. It's fine. We're going to have sleepless nights on that. So now let's move on to actually answer part 1. So what is part 1? Part 1A, prepare only the equity section of the consolidated statement of financial position of whoever that is. Okay, so let's do that. I'm just going to quickly go to Excel or Google Sheets. Okay, you should be able to see Excel or Google Sheets. So let's deal with this. So we need to do part A, which is prepare the statement of financial position, equity section only. Okay, so how will that look? So remember the three things we're going to do when it comes to the equity section. I mean, when we come to the statement of financial position is the company name and the date. Okay, so how does that look? It looks as follows. So company name, it is AWTY Ltd Group as the company name. We're doing this, then we put the statement name. So remember, when it comes to a group, don't forget to include the term consolidated. So we're going to say consolidated statement of financial position. So remember, every statement is for the period ended. So in our case, it's a year. So we say for the year ended, besides the balance sheet. The balance sheet we say as at. Don't lose your mark because you said for the year. Okay, so make sure it is as at, then the date. You include the date over there. I'm just going to put it over here so to show you the three aspects. So 31 March 2019. Okay, I'm going to check something quickly. Yes, remember when you do financial statements, they say prepare the equities of the financial statements. They didn't say ignore comparatives. So technically speaking, we should be including comparatives because they didn't say ignore comparatives. But why won't we include comparatives? Because they never gave us information relating to comparatives. Okay, so but if they did give us information relating to comparatives, then we would have to include comparatives because they did not say ignore comparatives. But in this scenario, they never gave us any comparative information, so we won't include the comparatives. Okay, so just take note. So we're going to have equity. So your typical equity would be as follows: share capital, retained. I'm going to include everything that you should be able to that we have covered so far, that you have been exposed to. All of it's not going to be relevant in this scenario, but I'm just going to include everything. Okay, so retained earnings. So remember share capital, retained earnings. Then so share capital is share capital, retained earnings basically represents your profit or loss. Then we're going to have the OCI sections. The OCI sections we dealt with so far is revaluation surplus. It was marked to market reserve. And then in this scenario, so I'm going to put it over here because it's relevant to this scenario. It is foreign currency translation reserve. Okay. And then, so here we have share capital. Then we have the profit and loss line items in the income statement, close of the retained earnings. Then these three are all OCI related stuff that have their own separate equity balance. Okay, so those are the stuff you were exposed to, and don't forget you are also exposed to change in ownership, whatever, change in shareholding. Yeah, ownership. So remember, this change in ownership was when there's a change in ownership, and before and after the change in ownership transaction, you are still a subsidiary. So the gain or loss on that transaction went into the column called change in ownership. Okay, so I'm going to highlight it in orange because these are not applicable for this scenario. I'm just showing you all the line items that you should be able to complete when it comes to a statement of changes in equity. Okay, so then this will give you equity attributable to the parent. Okay, and then we're going to have non-controlling interest. And that will give you total equity. So basically, all of this is your columns of your statement of changes in equity. Okay, so just be aware of that. That is all your columns of the statement of changes in equity. So column 1, you have share capital, then retained earnings, then all the other reserves, then you have total, then you have parents total, you have NCI, and then you have total. So that's basically it. Okay, so make sure you can do the balance sheet as well as the statement of changes in equity. If you are able to do the statement of changes in equity, then automatically you're able to do the balance sheet. But it does not mean you can do the balance sheet that you can do the statement of changes in equity, because obviously the statement of changes in equity, you need to show specific line items. Where with the balance sheet, you can just do any type of calculation. So just make sure you can do it from a statement of changes in equity way so that it's easy when it comes to the balance sheet. Okay, so that's basically what we're going to work towards. Okay, so now we're going to, so basically we need to work out, we need to get share capital. I'm just going to put this in orange over here because it's not applicable to this scenario. Okay, so we need to get 4 line items: share capital, retained earnings, foreign currency translation, and then non-controlling interest. What we're going to do, we're going to set up an analysis of equity. And from the analysis of equity, most of the marks is going to come from there. Okay, and then we will complete the answer. Just to get like a quarter mark, maybe a half, we plug in share capital. If you look on the share capital won't change for our purposes. So if you look on the preliminary consolidated trial balance, share capital was given to us as 100,000. Okay, so at this point, at this point, we have 1 1/4 marks or 1 1/2 marks. So this is a quarter mark or half a mark, if any, and then the setup is 1 mark. Okay, so all the other marks is going to lie in the workings. So to get the foreign currency translation, we're going to have to set up the analysis of equity. The non-controlling interest will come from the analysis of equity, and then we're going to have a retained earnings calculation. Remember, the retained earnings, what does it represent? It represents the parents, 100% of the parents' retained earnings plus. So retained earnings represents 100% of the parent's retained earnings plus the parent's portion of the subsidiary's retained earnings. And so in this case, only subsidiaries retain earnings. It could have been like analysis, associate and so forth. So remember, the retained earnings only represents the parent's portion. So remember, the parent's portion of the parent is 100%. The parent's portion of its subsidiary will be whatever percentage it is, and the parent's portion of the associate will be whatever portion it is. So it's very important that this section over here only represents the parent's portion. And that is why we include 100% of the parent, because the parent owns 100% of itself. But when it comes to the subsidiary, we don't bring on 100%. We only bring on our portion. So just to understand this over here, I'll put it on the side. Remember, the accounting equation is assets equals equity plus liabilities. When it comes to groups, we kind of look at it like this: assets minus liability equal equity. Okay, so we kind of look at it like that. When we do consolidation, we bring 100% of the subsidiaries, assets, liabilities, income and expenses onto our books. So therefore, on the statement of financial position, the assets represents 100% of the subsidiary. The liabilities represent 100% of the subsidiary. The income statement, the profit or loss, and other comprehensive income, and as a result, total comprehensive income represents 100% of the subsidiary. But remember, below total comprehensive income, we have profit attributable to, and we have total comprehensive income attributable to. So the income statement has 100% of the income and expenses of the subsidiary, and same the balance sheet. The assets have 100% of the subsidiary, and the liabilities have 100% of the subsidiary. So over here, it is basically 100% of subsidiary minus 100%. So assets of subsidiary, assets of sub minus 100% of 100% liabilities of sub. Then that equals, so what does that equal? It equals equity, but what does equity equal? Equity equal parent plus NCI. So that is why, what does equity represent? This here is equity. So we don't bring on 100% of equity for the parent. We will now say of equity, a portion belongs to the parent and a portion belongs to NCI. So that is why this over here does not represent 100% of the subsidiary. It only represents the parent's portion of the subsidiary. Very important, very, very, very important. Okay, they expect you to just know that. Okay, so just be aware of that. There will be situations, maybe in a complex question, where you need to work out certain numbers, and you must know, if you're using these numbers to work out, that if you're using any number over here, this don't represent 100% of the subsidiary. It only represents the parent's portion of the subsidiary. Very, very important. Okay. Okay. So we have the 100%. I'm just gonna add this up. So now we're going to do the foreign currency translation. So I'm gonna leave that for working one. I'm gonna, this is for the retained earnings. So retained earnings I'm gonna have as working one. Then I'm gonna have here working two. And then I'm going to, we'll see how we'll deal with that. Okay, so we'll just make this working three. So remember, the NCI is made up of the following. In this scenario, the NCI is made up of, so remember below the trial balance, I said the NCI of 45 million, that is all the other subsidiaries. Okay, so NCI, other subs, it was 45 million. This was given. Okay, so the only other part we need to work out is NCI, foreign operation. Now the foreign operation is going to come from working three. So the way we're going to deal with working three, we're going to, the way we're going to deal with working three is by doing an analysis of equity. So analysis of equity is not that complicated because it's only 1 year. We acquired the sub in the current financial year. So we're only going to have at acquisition. There's going to be no since acquisition, and then there's going to be current year. So we're going to have here AOE of endgame so yeah, we're gonna have total NCI. Okay, so let's have a look. So here we're gonna have details. We're going to have so we're gonna have details. We just set it up exactly the way they had it in the question. So exactly the way they set it up, that is how you set up an analysis of equity for a foreign subsidiary. Okay, so it's going to get the so here we're going to have total. Okay, so total mean 100%, but of what? Total, I will call it foreign currency. Okay, just say total ZMK, that's foreign currency. So that's foreign currency. Then we're going to have rate, and this is going to give us total ZAR. Okay, now what we're going to have to do, we're going to have to split it between the parent and NCI. Okay, now we're going to split it between parent and NCI. So over here, it's going to be parent at 85%. So this is going to be at acquisition. And that's going to be since acquisition. And then we're going to have basically NCI at the difference, which is 15%. So all we're going to do, remember, at acquisition would be as follows. So at acquisition, which is 1 April 2018, we do the at acquisition line items. So it's going to be, all we had at acquisition was share capital, and it was retained earnings. Share capital, retained earnings. So we have share capital, and then we have retained earnings. This is going to give us whatever it is. So this they told us was 50,000. They told us this was 73,030. Let me just check quickly. Okay, yeah, 73,030. Then we're going to have goodwill, and then we're going to have total. Okay, so then we're going to have goodwill, then we will have total. So here we will have a total. I'm just going to call the subtotal. You don't have to put anything over here. I'm just calling it a subtotal. Then we have goodwill, and then we're going to have total equity. Okay, so we can use what they have. We're going to use whatever they have at the moment, and then we will do the rest. So he had equal. So we had that. Goodwill, we're using the partial goodwill method. Why is it partial goodwill? Because NCI is measured at the proportionate share. If NCI is measured at fair value, then it is the full goodwill method. Okay. So they told us that, what did they tell us? What did they tell us? Oh, they tell us goodwill is 21,139. Goodwill is 21,139. 21,139. Okay, so the total equity over here is as follows, the sum. Now, the question is, what rate do we use? What rate do we use? What rate do we use? We use the spot rate at the date of acquisition. The date of acquisition, 1 April 2018, and we use the rate at that date. The rate at that date is 140. In his calculation, he had 140, so that is correct. Okay, so we apply the rate over here, 1.4. So which rate do we use? The rate at acquisition, very important. So therefore, the ZAR is going to be the 123 times the 140. Okay, so that's 172. And similarly, with the goodwill happens at the date of acquisition, so we use the same rate. So 1.4, and over here it's going to be 21 times the rate at acquisition. And if we add this up, we're going to get that. So now we give the parents portion. Okay, so now we give the parents portion, and then we give NCI's portion. Okay, so what is the NCI and what is the parents portion? So let's have a look. So NCI is going to be that times times 15%. NCI gets nothing of goodwill because it is the partial goodwill method. So that is 0. And then at acquisition, they will get that times we get 85%, and we get the full goodwill because all the goodwill belongs to us. So if we add this up, so that is at acquisition. Okay, so we're happy with that as is. Okay, now we're going to deal with since acquisition. Remember, since acquisition, there's nothing for since acquisition. Why is there nothing for since acquisition? Because we acquired in the current year. We can only have since acquisition if we had a closing balance. So we had no closing balance, so therefore there's no since acquisition. So we're going to only have a current year. So over here, there's no since acquisition. So now we're going to have current year. And current year is 1 April 2018 to 31 March 2019. Okay, so now we can deal with this. So once again, what you do, like normal groups, you slot in profit for the year. That is given. So profit for the year that is given, it was given at, I think, 36,700. So it was given to us as 36,700. So we just take that number as is. So just make sure you see where you got the where I get the 36,700. I think it's in point number 2 or something like that. So we're going to use 36,700. So we take the number as is. Okay, so that's important. Then I'm going to show you now what we need to think about. Okay, so 36,700, that is the profit given as is. Now we ask ourselves the question, okay, is there any adjustments that we need to make? So remember, the one adjustment is any intercompany transactions, and the answer is no. The second is, what was the second one? Tell me. Fair value adjustments at acquisition, and the answer is there was no fair value adjustment at acquisition. And in this case, we need to adjust for the loan. Okay, so we're going to just say Forex on loan, Forex on loan, and then don't forget there was a dividends. So we must ask ourselves, is the dividends in this period? The dividends was declared on 28 February 2019. So we're going to have dividends over here. Okay, the dividends, I think, was 25. Dividends decreases profits, so therefore decreases equity, so therefore we say minus 25. Now we need to work out the Forex on the loan. Now we need to work out the Forex on the loan. So this is going to be extremely, extremely important, okay? So now we're going to work out Forex on the loan, and this is going to be now extremely important for us to actually work out. Now, remember, the Forex on the loan that they have to do, they're recording a foreign amount in their books. The only way the loan can change is the loan can change in 2 ways. It can either increase or can decrease. Now, the loan can increase in 2 ways. Either they took out, they received additional loan, or it can increase through interest. The loan can decrease through a repayment. Now they're telling us there was no specified date of repayment, so they made no repayment. Then it's an interest-free loan, so there's no interest, and they never mention of any additional loan being taken out. So that means the loan balance did not change. So the only way the loan balance can change is as a result of a foreign translation. Okay, so we're going to do that working now. So the working for, so here we're going to have working for, we're going to have details, then we're going to have ZMK, we're going to have rate, and then we're going to have ZAR. Okay, so what's going to happen over here? We're going to say opening loan. There was no changes. So the opening, so the only other balance would be is closing loan. Okay, so there's no interest, there's no repayment, there's no additional loan. So we can simply say opening loan, closing loan. So the opening loan is, when I tell them which date, 1 April 2018. The closing loan, 1 April 2018. The closing loan is 31 March 2019. Okay, remember, when you have, we always do a foreign currency translation at year end. 31 March 2019. So the loan amount was given to us. Okay, so the loan amount was given to us. What was the loan amount? It is that 4414. Okay, so the loan amount, the ZMK loan amount is 4414. So opening balance, they received 4414. At closing balance, the amount was the same, 4414. Now we want to get the ZAR amount. So we must apply the rate at the date that the transaction took place, and that was on 1 April 2018. 1 April 2018 was 1 Rand 40, I think. Let's see quickly. Was 140, because we received the loan what you call it, and then and then we just work out what it was on 31. What it was on 31. I wanted to do now here quickly. So remember, the only way this loan can change is as follows. So I just want to show you something quickly. I'm just going to play a critical role. No, so you mustn't do it like this. So just take note. So on 1 April, what was our balance? 4414, right? Our closing balance, we need to get the foreign exchange amount. The foreign exchange amount is going to change as a result of the ZAR amount. They gave us a ZAR amount of, so if you look at 31 March 2019, they told us the loan amount in ZAR is 56,580. So over here, this is equal to 56,580. But we don't, let me just see if I have the right number, 56,580. So remember that 56,580 is a ZAR amount. We need to know what is the foreign currency amount. The way we're going to get that is to convert the ZAR amount to the ZMK. The way you're going to do it is just divided by the closing rate. The closing rate at 31 March 2019 is 1 Rand 90. So as you can see, there's a change in this closing balance. And it's solely got to do with exchange rate. Now, what we're going to do is the following. So the change in foreign currency, because we need the change in foreign currency. So the change in balance is the difference between the two. Okay, so it is that minus that. Okay, so it's 10,635. So what you must understand, for them, they owe us less. So therefore, the exchange rate was favorable. So it is a gain to them. Okay, so if we go to, where am I now? So the Forex on the loan, it's going to be a gain to them. So it increases their profit or loss. So it's going to be that 10,635. So just understand what happened over here. We want to get the change in foreign currency. We received 40, whatever that is, 40 ZMK. The closing balance is now sitting at 29 ZMK. How do we get 29 ZMK? They told us that the ZAR amount is at 56, whatever it is, 56 million. But that 56 million, how did they get the 56 million? They said ZMK times closing rate. So ZMK times 190 gave us the exchange, the ZAR amount of the loan to be 56,580. We don't want the ZAR amount. We want the closing, the ZMK amount, the foreign currency amount, because we need it to complete our analysis of equity. So that's what we said. That minus that gives us 10,635. So the question is, how do I know I must increase profit or loss? How do I know I must decrease profit or loss? On 1 April, as a result of the exchange rate, they owed us 40 million. At 31 March, they owe us less. So from ZMK's perspective, they owe us less money. So therefore, to them, the Forex was a gain. If they owed us more money, the Forex would have been a loss from their perspective. So therefore, in their books, they made a gain, or they should have made a gain of 10 million, so that would increase their profit figure. So just take note of that. Now, we have accounted for the profit for the year as given. We asked ourselves, is there any intercompany transaction? There was nothing. Is there any fair value adjustment at acquisition? There's nothing. There is a Forex on this loan adjustment, so just you must take note of it, okay? It will come through probably often. And then we also saw if there's any dividends as per normal. The dividends there was on 28 February 2019. Very important to take note of the date of dividends. You're going to see why now. Now, we will be able to complete the calculation. I'm going to do this. Okay, so I know there's no other adjustment, so that's fine. I'll just do this. Total equity before goodwill adjustment. Okay, so that's total equity before goodwill adjustment. And then we're going to have the goodwill adjustment. So not goodwill adjustment, FCTR adjustment. So it is equity before FCTR. And now we're going to have FCTR. You can have two types of FCTR. FCTR goodwill, FCTR just know everything else. Okay, so you don't have to put anything else. FCTR just everything else, and this is going to give us total equity. Okay, the FCTR will only impact the translation. It's not going to impact the foreign currency. Okay, so what you're going to see over here, if I add up, I'm going to say sum. I'm going to add up from the last balance up until the end. From the last balance up until the end. So just take note of that. I'm going to add up from the last balance up until the end. Okay, there's not going to be any adjustment over here. Okay, in foreign currency, you only have a foreign currency translation as a result of converting from one currency to another. There's no conversion in this column. So therefore, this total equity will equal the same. Okay, so that total equity will equal the same. Now, here is where the foreign currency translation reserve come into play. So, profit for the year. Profit for the year is an income statement balance. Technically speaking, you must use a transaction amount, but obviously we're not going to do a transaction amount, so we use the average exchange rate. So we use the average exchange rate for the 2019 financial year. If you look on the table, the average exchange rate, the average exchange rate on the average exchange rate on 2019, for the 2019 financial year is 1.65. Okay. So the average exchange rate is 1.65. The Forex also represents for the full financial year. So therefore, we also use the exchange rate of 1.65. Now, when it comes to dividends, the dividends must be translated on the date the dividends was declared. Now, the date that the dividends was declared was, let's go check quickly. So very important income statement. You just use the average. Technically speaking, must use the transaction date, but we just use the average because it represents for the entire year. But dividends must be translated on the transaction date, the date that dividends was declared. Where is that now? So dividends was declared on 28 February 2019. The rate on 28 February 2019 is R1.90. Okay. The total equity must also be translated. So total equity, this balance over here, this balance over there, must be translated using the closing balance. Because it represents a balance, you must use the closing balance at year end. What the closing balance represents the balance at year end. What is the balance at year end? It is R1.90. So what you will notice is the following. What you will notice is the following. What causes the foreign currency translation reserve? If you add up all of this, it comes to zero. So you have total equity. So here you have total equity. And you have, so total equity is that, and which is basically the sum of all of this, right? So from a foreign currency point of view, it all balances out. But over here, if we were to convert all of these line items at the same exchange rate, there would be no foreign currency translation reserve. But as you can see, opening balance is based on the closing rate of last year. Income statement line items is based on an average, and dividends is based on a particular date, and then we have a closing at a completely different rate. So because we're using different rates for different balances, we're going to end up with a balancing figure. That balancing figure is going to be your foreign currency translation reserve. Okay, so that's very important. So what's going to happen? This needs to be at R1.90. Our total equity needs to be at R1.90. So what's going to happen? Just look here. So when I say 166 times R1.90, I get an expected balance of 316,358. But look what's going to happen. When I say that multiplied by that, I'm going to get, okay, so I just drag this down. Now, if I add up, so remember, when I add up all of this, what did I get? I got 166,504. So basically, when I add up this, I want to end up getting 316. So when I add it up, I want to get 316,358. But what am I getting? I'm getting 232,439. Why is there a difference? The difference is because of the fact that we are translating at different rates for different transactions or different line items. So that difference we take to FCTR. But for our purposes, we split FCTR up between everything else and goodwill. So FCTR is basically going to equal 316 minus 232. FCTR is going to equal 83,000, whatever that is. FCTR is going to equal 83,000. The way we're going to get that is by working out FCTR relating to goodwill, and then basically just the difference between the two. Okay, we'll go to everything else. So let's work out FCTR for goodwill, and we'll work out the remaining FCTR. So I'm just going to include a working. I'm just going to show you. You don't have to do this long working for the calculation, but just so you can see how it's actually done. I'm not. So in an exam, you can just do it in brackets. So in an exam, the working I'm going to do, you can just show in brackets over here. Okay. So you don't have to do the long, but I just want to show you the long way so you can. It's easy to see it when we look at it. So the way we're going to do, you just basically say. So for goodwill FCTR, we're just going to do the following. FCT, okay, details, okay. This is for goodwill FCTR. So FCTR goodwill. And this is for the closing balance. So for the closing balance, what we're going to do, so what we're going to do, we already have the opening balance from the calculation. So there we go, 2959, whatever it was. Then over here, what was goodwill? Goodwill was 21,139. So over here it's going to be 21,139 multiplied by the closing rate of 1 Rand 90. So over here is going to equal 21,139 times the closing rate of 1 Rand 90. So the adjustment is going to be that minus that. Okay, so the FCTR goodwill movement is going to equal working 5, which is going to be that. Okay, then for working 6, it's simply going to be the following. Show you now. It is simply going to be the following. So once again, you don't have to do this working. You can just do it above. I'm just showing you how we deal with it. Okay, so we're going to say total equity. So you don't have to do this long calculation in the exam. I'm just giving so you can, this is just to help you with the thinking process on how to get the number. Okay, so this over here, goodwill FCTR is that. This comes from working 5. So remember working 5, working 6 is just to show you the thinking process. You don't have to do such a long calculation in the exam. You can simply just do it in a bracket. You can just simply do it in a bracket. Okay. So this over here is 316. That is going to be 232,439. So as you can see, total equity minus total equity before FCTR adjustment is going to be that minus this. So pay careful attention as how you get 316,358. It is total equity foreign currency multiplied by closing rate. How do we get total equity before FCTR? It's taking all the transactions of equity multiplied by the applicable exchange rates, adding opening balance plus that, you get a balance. You will realize that that balance versus the equity, closing equity times closing rate will be different, and that is as the result of the different exchange rates. That movement we call FCTR, right? So now we're saying, okay, FCTR is 83,918. Now we need this FCTR to be split between goodwill and the remaining FCTR. So therefore the remaining FCTR will be 83 minus 10. Okay, so it's going to be 73. So that is 61. 61. C61. That's going to equal C61. Okay, so that is basically it. So when we do this calculation, it needs to come to 0. So that minus the sum of this needs to be 0. Okay, so now we know that thing balances. If it don't balance, we know there's something not right. Okay, so that is the 100%. Okay, now we need to split between what belongs to the parent and what belongs to the parent and what belongs to NCI. Okay, so that is going to be the next step. So what belongs to the parent and what belongs to NCI. Where am I now? Okay, so we're going to have to give the parent its portion. So that is 100 times 85%. We now mustn't do it there because remember this must go in the since acquisition column. So it's going to equal that times 85%. Okay, and then this is going to be that multiplied by 15%. Okay, so just take note of that. Add up. Over here, remember the full, because this is important, the full goodwill goes to the parent because it is that the parent is using, because it is partial goodwill method. What makes a partial goodwill method is because NCI is measured using their proportionate share. If it was what was the other one? If it was full goodwill, where NCI is measured using fair value, you'll have to do a split. So just take note. Then this is going to be that times 15. And that is why we split between what belongs to goodwill. That's why we split FCTR between goodwill and everything else. There's no need to do that split if you're using the fair value method. Okay, but it's just best to do it this way. That times 15%. Okay. So that basically is it's done. We're gonna work more on this tomorrow. The analysis of equity when we deal with a change in ownership, but I'm gonna stop on the analysis of equity over here for now, because that is what we require to complete the question above. So now we can work out NCI and we can work out everything else. So let's do this. It's kind of equal. So now we can take that for NCI. So working to NCI, this year is 31 March 19, which is the closing balance. I can go fetch it from working 3. That is that over there. So this over here is closing balance. That is NCI's closing balance. Take note, what is NCI's closing balance? NCI is equal to NCI at acquisition plus NCI since acquisition. In this case, it's 0 because there's no since acquisition, plus NCI current year. Okay, so NCI is NCI at acquisition plus NCI current year plus NCI since acquisition plus NCI current year. So NCI at acquisition, there's no NCI since acquisition, and then we have this year is this year that plus that is NCI current year, which gives you NCI at 31 March 2016. So total equity 31 March, not 2016, 2019. So just take a note of that. So I'll highlight this in different colors so that you can see the color codes. Let's start there. Okay. So now I can go plug this in. So this is C22. So remember, what is NCI? NCI is NCI that was given to us, which represents NCI of all the other subsidiaries, plus NCI of the foreign sub. NCI of the foreign sub, you just look at the NCI column and you use a total balance at the date you are looking at. The date we are looking at is 31 March 2019. Okay, now we can work out. Foreign currency translation reserve. Okay, it's going to come from working 3, but maybe I'm going to change it to be over here. Okay, so I'm going to do a bit of a longer calculation so you can see what I am doing. So basically, the foreign currency translation reserve, remember, if we have a look at this over here, so this is very important to take note. Foreign currency translation reserve is sitting over here in the balance equity attributable to the parent. So therefore, you can only take the column for the parent. And then whenever we deal with the parent, we only work with the since acquisition column. We don't work with the at acquisition column. Remember, everything at acquisition gets eliminated. So therefore, when we work with the parent, we work with the parent from the since acquisition. And that is why when we do the parent, we have 2 columns, one for at and one for since, because we need the at acquisition to get total equity, but at acquisition doesn't belong to the parent. What belongs to the parent is only since acquisition. But with the NCI, we include the at acquisition component. So just take note of that. So because foreign currency translation reserve relates to because foreign currency translation reserve relates to the parent, we can only use the column of the parent. And when we use the column of the parent, we only use since acquisition. Okay, so to do that, we want FCTR, right? So we want FCTR. The reason why I'm doing this calculation is going to be an important aspect. In an exam, you don't have to do this calculation. You can just kind of highlight the numbers on your working three, on your analysis of equity, and plug it in. I'm just doing this because I want to draw attention to an important concept. Okay, so that is going to be the ZAR. So we want FCTR goodwill, and we want the remaining FCTR. Okay, and we want the remaining FCTR. But remember, which column do we use? We use the parent. How do we know that? Because the FCTR balance is sitting in the balance sheet attributable to the parent. So we only use the amount that is attributable to the parent, and that is going to be the since acquisition balance. So if I do this, only FCTR, so if I look at the analysis of equity, there's no opening balance for what you call it. So I can only, so when you look at the parent, you always only start with since acquisition. There's no since acquisition, so there's only current year. The current year for the parent is going to be that for goodwill, and the one above for normal, the one below for the normal FCTR. So I'll just drag down the formula. So the important concept over here is when you deal with the parent, we only work with since acquisition, and we're only using the parent's portion. We're not using the total FCTR. Because remember, part of the FCTR belongs to NCI, and part of the FCTR belongs to the parent. So when we work with the equity section of the balance sheet, when we work with the statement of changes in equity, it's very important to distinguish what belongs to the parent, what belongs to NCI. Okay, that's the one important concept. The next important concept is this. We need to bring into the FCTR, FCTR, or I don't want to say FCTR, Forex on loan. The only reason why we're bringing the Forex on the loan is because from an accounting perspective, this loan is considered to be part of the investment. And the reason why the loan is considered to be part of the investment, because there is no stipulated repayment date. So accounting is saying because there's no stipulated repayment date, in substance, the loan is not a loan. The loan is actually an additional investment. If there was a stipulated repayment date, so if this was a normal loan agreement with specified repayment dates and so forth, then accounting is saying in substance, it is a loan and it is not an investment, then you won't do this. But because it is an investment in substance, we must bring in the Forex on loan over here. Because remember, the Forex on the loan should actually go through profit or loss. But from an accounting perspective, we're not taking through profit or loss solely because it's considered to be part of the investment. So that is the important concept I wanted to draw upon. So our total FCTR will include the Forex on the loan. And once again, we only take the parent's portion. So FCTR, the parent's portion. So this is C64. Where is this now? Equals C64. Okay, so I just want to highlight some stuff over here so you can see where we got the numbers. So take note, the reason why we're bringing that in is because, why we're bringing the loan is because the loan is considered to be part of the investment. Why is the loan considered to be part of the investment? Because of the fact that there's no repayment date. So from an accounting perspective, we're saying it is, in substance, it is part of the investment, even though it's said to be the legal form is a loan. Okay, so that is FCTR. So once again, you don't have to do this calculation. You can simply take it directly from the statement of change in equity. So here you have the statement of change in equity. You simply come over here, and in brackets, you can add them up or something of that nature. Okay, so you just take note for an exam perspective. I did a separate calc again, just to draw an intention for principal purposes. Now we're going to do retained earnings, which is working one. So retained earnings, remember the retained earnings given was the opening balance. Okay, so it's going to be retained earnings, parents' profit, and then dividends. Okay. Okay, so this is going to be retained earnings. This is going to be retained earnings before foreign sub. Now we must bring in the foreign sub. So the foreign sub, we just take in profit less dividends. Okay, so here we're just going to say, so for the foreign sub, it's going to be the profit, and it's going to be less the dividends. Now, once again over here, if the loan was a normal loan and not considered to be part of the investment, then you'd bring the loan, that forex on the loan over here. But because the forex on the loan is considered to be, because the loan is considered to be part of the investment, the forex gain is not included in profit or loss, but rather taken to FCTR. Remember, FCTR goes through OCI. So that's an important distinction. So this over here, where is that now? This forex on the loan, that this 10,000, which ultimately came to a 14,000. So that 14,916, that 14,916 could either be included in profit or loss or OCI. In this scenario, it is not included in profit or loss because the loan is not considered to be a normal loan. If the loan was considered to be a normal loan, this amount will be included in profit or loss. But in this scenario, the loan in substance is considered to be part of the investment. Why? Because of the fact that there's no repayment terms. So the accounting standard is saying that it's basically a further investment that the parent is making. So therefore, that forex exchange gain or loss is included in OCI as FCTR. So that's important. And that is why I don't bring the forex loan over here. Okay, so what's going to happen? Total equity. So total retained earnings. So basically, retained earnings including foreign sub. So the retained earnings that was given was 350, 123. The parent declared the dividends given was 34. The dividends given was 34. Parents' profit, what was it now? What was that profit given as? The profit was given as 68,150. The profit was given as 68,150. 68,150. So based on given information, the retained earnings correctly calculated from a group perspective. The retained earnings correctly calculated from a group perspective is 384,150. But that correct calculation excludes the foreign sub. We need to include the foreign sub, so we go fetch the profit. Which profit? The parent's portion. Critical. The parent's portion of 51,472. And in the dividends, it is the parent's portion of the dividends. Where is that? 40,375. Okay. So over here, it is working 3, working 3. I'm just color coding for you so that when you look through the analysis of equity, you know which numbers are used. So if I add up, so that is the correct retained earnings attributable to the parent from the group perspective before the foreign sub. But we needed including the foreign sub. So therefore it comes to 395,247. 395,247. So this over here is C25. So if I go over here, C25. So that the parent's portion, 583, non-controlling 86. So total equity is 669,507. Okay, so that is basically it, what you wanted to do. So this was easy mark over there, the share capital. There was important principle. So the important principle is when you're dealing with equity, you only want the parent's portion because the other portion belongs to NCI and NCI is shown over there. Okay, so that's all that I wanted to cover. Is there any question from your guys' side? If there's no question, you guys are good to go. But before you go, ask any questions or just tell me how you found the section. If you don't have any questions, just at least tell me how you found the lesson, as in the topic. Andile, Bernice, Umaira, Lebo. I'm going to add, I have currently the book is included in the my registered student section. I will make a copy and include it in the test 4 section where you found the other test 4 stuff. Okay. Okay, Valis, Tandi, Nandipa, Mzwa, Mercedes. Any questions your guys' side? Nothing? You guys are good to go.
Thank you very much, Faiz.
Pleasure. Okay, thank you guys.